Welcome back, students who are taking financial accounting, and in this series of videos we are going to work on the theory aspect for chapter 11, which is about the statement of cash flows. Okay. In this introductory video, right, you know, what we're going to cover is cash is king versus financial accounting, to give an overview of what the statement of cash flow is and sort of how it's created, right? Then in future videos, we're going to cover the sections on the statement. There's 3 sections: operating, investing, and financing. And then we'll also cover the formats for creating the statement of cash flows using the indirect method and the direct method. And of course, at the end of every chapter, there's been this focus on decision making to look at some financial ratio. All right. So we'll cover cash is king versus financial accounting in this video, and then do the others in future videos. And again, how many videos, I don't know. We'll just see as we go along. Right. Let me get my pen here. Okay, cash is king versus financial accounting. All right. We back, in the beginning of the textbook, in the first couple of chapters, you were introduced to the idea of the cash basis versus the accrual basis of financial accounting. Okay. And basically the cash basis is you only create journal entries when you have a transaction that affects cash. Otherwise, you don't make a journal entry. Right? The accrual basis, you make a journal entry whenever you have any kind of transaction. Right? So let's just take a look at this real quick to get a little bit of an understanding. Now, let's say we go to Home Depot. Let's say I'm a handyman, okay? And all right, here's Home Depot. Here is, well, actually, let me do it like this. Ran into my head here. Okay, here's Home Depot. Okay, here's a customer, all right, and here's me, okay, the handyman, all right. Now, basically, think about what happens here. The customer says, oh, I need some work done. So you say, okay, I'll do the work for you, all right. And when you're looking at it, maybe it's, let's just say it's replacing the bathroom floor and the toilet because there's a leak in the toilet and it rotted the floor or something like that. Okay. Well, you're going to look at the customer and say, oh yeah, this is going to cost you $300 to do. And the customer says, fine, do it. Well, most often you don't have the cash on hand, all right? But you're going to need to buy the materials from Home Depot in order to do the work. Now, let's say in scenario 1, and we were using the cash basis, we did have the cash on hand. So I would end up debiting my supplies, and let's say they cost $100. And then of course I would credit cash, right, for $100. Okay, on the cash basis, whenever we affect cash, we make a journal entry. Right? But now let's say I didn't have that money, okay? I didn't have the $100 I needed, all right? So I go to Home Depot and say, hey, Home Depot, can I buy, that $100 of supplies on account? And they say, sure, you've got good credit. So you're going to pick up the supplies for 100, and they're going to credit accounts payable for the 100 because you owe them the other $100. Okay, so now you're able to go and take that supplies. Now you owe Home Depot $100, but you take the supplies to the customer, you do the work, and you get paid the $300. Okay, the customer's happy because they had their bathroom is now fixed. You're happy because you made $200, and now you have to pay off Home Depot, so they're happy. Okay, so you end up debiting accounts payable for the 100, and you credit cash for the 100. Okay, so in essence, the net effect is that this credit to accounts payable washes itself out. Okay, that's that debit and credit washes itself out, and all we're left with is this here debit to supplies and the credit to cash. Okay, So we basically have the same exact transaction as we had in the cash basis, but the difference being is if I didn't have the $100 in my pocket, I couldn't do the job. But by using the accrual basis, where we can in effect put off transactions or account for things without having to use cash, I'm able to do the job. Home Depot gets paid, the customer's happy, everybody's happy. But if you don't have that, the customers would still have a bad bathroom. Home Depot wouldn't have sold anything, and you wouldn't have made any money, right? So using the accrual basis of accounting, that allows us to facilitate business and make it profitable for everybody. Now, when a business first gets started, a small business, right, would start off using the cash basis. They could, okay, but 99% of the time, any accountant is going to start up the business and set it as the accrual basis, right? Really, the only time that you would actually use a cash basis is if you know that the business there's very few transactions, and nobody, and the business isn't going to grow. It's going to stay like that. So let's say, for example, you have a 4-unit apartment building right here, right? And that's all it's going to be in the business ever, okay? Well, then maybe you might set that up as a cash basis. But then again, for something that small, you're not going to be so interested in creating financial statements, right? In order for investors or the bank to make a bank loan, right? You're not going to need financial statements for third parties, okay? All you're basically going to do is, at the end of each year, you're going to do your taxes. And since everything's done on cash and there's very few transactions, there's not much in doing to be able to do your taxes. But as soon as the business gets a little bit larger, okay, whether you need to use financial statements or not, right, it makes more sense to do the accrual basis, because again, it facilitates doing business. Okay, let's say here's a 4-unit apartment building. Well, what if you went out and also bought a 16-unit apartment building, and now you have maintenance people, right? Or you're going to maintenance, or you're going to do the work, and you need to go to Home Depot in order to fix it. Well, now you see how the accrual basis works. So throughout most of this textbook, well, all of the textbook, including those first 3 chapters, you've been using the accrual basis, and you've been looking at those financial statements. Now, here's some financial statements, and I'm not going to get into the adjusting of them just yet, or creating, quote unquote, the statement of cash flows. In this video, all I'm doing is just trying to give you a lay of the land as to cash is king versus financial accounting, and the reason and purpose for the statement of cash flows. Right? Now, cash is king in the respect of, here's my financial statements, and they're done on an accrual basis. However, if I don't have cash, I can't run my business, right? And that's why cash is king, right? Businesses need to track their cash to be able to see when they have the money to be able to pay for things, okay? All of the additional stuff is inconsequential if you can't pay your bills. But when you're looking at your financial statements, since they're done in an accrual basis, right? If you want to understand your cash position, right, then you would end up having to adjust all of these financial statements, and it makes more sense not to adjust them. It makes more sense to create a statement of cash flows. So there's a relationship between these financial statements as they sit and the statement of cash flows, because some of the information that we put on the statement of cash flows comes from these statements, and it's something where you like, for example, net income. Okay, well, if my net income here is 48,000, right, and that's on my statement of cash flows, I knew that came from my income statement, right? It's sort of like your retained earnings here. Okay, if you have your balance sheet, you have retained earnings here on your balance sheet, and you know that if you want to see the detail for that number, you look at the statement of retained earnings. Well, this is the same type of thinking. You have these you have these two financial statements, the balance sheet and the income statement, and if you want to know your cash position, you look at your statement of cash flows. Now, because remember, these statements are in the accrual basis. So to give some idea as to what it is that we're going to be doing here, we'll just concentrate on the income statement here for our purposes here to give you a little bit better idea. All right. When we look at our income statement, we have our revenues and we have our expenses. Right? But and so we have this net income here of 48,000, right? The difference between the two. Now, remember, this here is based upon the accrual basis, right? So when we make sales, we know that we don't make all of our sales using cash. We make some of our sales using credit cards, accounts receivable, right? Accounts receivable is not a cash account, nor is taking a credit card payment, right? That's not a cash account. So we have to make some adjustments in order to be able to understand what we actually sold using cash. We also have additional consideration in that something like this depreciation expense. When we make adjusting entries at the end of the accounting period, this depreciation expense is a phantom expense. It doesn't affect cash whatsoever, but yet it's part of this net income of the $48,000. Okay, so what we're basically doing is we're saying, okay, we're going to take this here 48,000, and we're going to look at everything that's on our income statement, and we're going to make adjustments to the 48,000 so that we understand what it is that we had for net income in cash. Now, that's a simplistic thought process here, because I'm only talking about the income statement. You have to consider the balance sheet also, okay, and adjustments from the balance sheet that affect our cash position. All right, and that's what we're going to be doing throughout the rest of the videos here, and then of course the homework assignments. For the most part, when you're learning this, as always, it's about understanding a concept and then applying it to the situation. But a lot of people struggle with the statement of cash flows because there's a lot of steps and a lot of things that you have to take into consideration. And if you just keep in the back of your mind that, does this affect cash? Okay, if you always keep that in the back of your mind and you think about the effect on the cash, then you can look at any set of books and go down account by account by account and figure out whether that should be on your statement of cash flows or it shouldn't. And if it does go on your statement of cash flows, how do you adjust for it? Because you're going to see that it gets a little hairy here where you would think, I do one thing and then I have to reverse. You'll see. I don't want to get too complicated here. But the point being is that you have to consider it, the effect on cash. So the way the textbooks and most efficient way that I know of learning this, of how to do this, is to kind of like copy what's in the book as sort of like a recipe. Okay, these are the most common things that you're going to do in order to be able to create your statement of cash flows. And if you think about how it affects cash, all right, then if you happen to have a business that has something on it that you've never seen before, okay, well, if you understand the thought process, all right, and its effect, then you can look at this new unseen, unknown transaction and apply the same type of thinking to decide whether it should be included in the statement of cash flows or not. Now, I realize I'm being nebulous here. I mean, because I don't have a concrete example, and you'll see that in these next videos, because I'll kind of like go through a lot of the steps and try and explain them to you. But understand the thought process. See why you're putting this on your statement of cash flows. Always remembering, keeping in the back of your mind, that what we're trying to do is we're trying to get to our cash position. Okay. And if you can follow, that thought process, whenever you have something new that you've never seen before, you can actually work it in. But for the most part, what you have in the textbook should cover generally 95% of whatever it is that you're actually going to see in businesses. They're the most common transactions, adjustments that you'll make in order to create your statement of cash flows. So with that said, that's it for this introductory video. And as when we go forward, as you see the creation of the statement of cash flow, you'll hopefully this introduction, you'll see why, see how everything fits into place. All right, so with that, we'll move on to the next video, since this is already 16 minutes long, and we'll start talking about the different sections on the statement of cash flows.